Hey, good afternoon or good morning if you're on the West Coast. Welcome to the Q3 Richie May Mortgage Trends Series. Higher for longer, mortgage rates and the path ahead. Should be an interesting conversation today. Before we get started, introducing our special guest. The webinar is being recorded. The recording will be distributed a couple business days after those who registered. You could download the slide deck from your dashboard. You can also submit questions at any point in time. We will try to get to as many questions as we can. If we don't get to them, we will certainly follow up with you. There's an ask question widget on your dashboard. So at any point, ask a question and we'll try to get to it. And there's also a feedback screen. So your feedback is very valuable to us. Use the emojis to let us know your thoughts. And please take the survey available on your dashboard as well while we are doing this presentation today. A little bit about Richie May. For those that may not be regular subscribers to our trend series, Richie May has been in the business 40 years, focused, dedicated to the mortgage industry space. We spend a lot of time on education and we spend a lot of time on innovation. And so this is part of the trend series for clients and prospective clients and industry folks out there. So there's a full suite of services and product designed for mortgage banking out here at Richie May Advisory, as well as deep expertise in both our audit, tax, consulting, and cyber groups. So we are focused on mortgage banking, and many of our employees, including me, spend a lot of time on presentations. And full disclosure, this is my second of third presentations today, so I may not have any voice left by the last one. But today, I am fortunately to be joined by a former colleague of mine at SunTrust, but Cameron Beane, who is a capital markets expert. Cameron and I go way back. Cameron, do you want to give a brief introduction of yourself for everybody so they know who you are if they don't know?
Sure. Thanks, Seth. Great to be with you today. Hi, everybody. Good to be here. I've spent 32 years in secondary marketing, capital markets, portfolio management, mostly with publicly traded banks, a few mortgage REITs, life insurance companies, all running sort of hedging and trading and valuation for all different types of products in all different types of rate scenarios and price scenarios. Super happy to be with you today and share a few thoughts about where we are and how to think about some of the risk management strategies about where we're going.
Great, Cameron. It's always great to see you. And Cameron and I go way back to the SunTrust days. We fought as we like to say, we fought the SunTrust wars together back in the good old days. So this is the agenda for today. For those that aren't playing bingo with us, if you're new to this, we created a bingo card beginning of this year. Boy, some of these predictions may not be looking all that great at this point, but hey, it's bingo, so there's no guarantee you're gonna get bingo, but if you're interested in playing along, you can download the card, and if you get a completed cards, please send it to us, and we'll send you some Richie May swag. Certainly, when this card was created, we weren't in a war, and we didn't have another war with Canada and all of this stuff going on. So anyway, it's just interesting to see where we're at, but let's get on to today's topic. Mortgage rates higher for longer, and this by no means is a new topic. There's a lot of people talking about this, but we do want to try to give you a slightly different perspective. So we're going to start off with, as we refer to it, the new Federal Reserve. Obviously, Chairman Walsh has taken chair of the Fed. He's giving a big speech tomorrow out here on the West, where I actually anticipate him to say nothing, because most of his speeches seem to be, he doesn't say a lot. But Cameron, from a capital markets perspective, let's outline a little bit sort of the old Fed, kind of where we're at now and where we think we might be sort of maybe first quarter or second quarter year next year when the Fed sort of figures out what their communication style is. And kind of from a capital markets perspective, like how different does it feel now versus a year ago when we sort of had Chairman Powell in and dot plots versus where we are today? And then we'll pivot to what we might see in the future.
Yeah, no, it's a great question. I think long gone are the days where we have the data surprises that tend to move the markets by a rally or a sell-off by 100 basis points in price, and yields are swinging wildly on one particular piece of data. Now we have that data, and we have the rhetoric, and we have the Q&A, and we have the legacy dot plots that are moving those markets almost daily, intraday, up 2 basis points in yield, down 3 basis points in yield, rinse and repeat. I think what is interesting is that Chair Warsh has made no bones about the fact that he's not a fan of the dot plot, and he's not a fan of trying to tell the market what it is that the market either wants to hear or doesn't want to hear. It was a very subtle comment that he made in his last Q&A, which went something to the effect of, the market is reacting and the market is making its decisions as the market should do. So maybe we should listen to the market, not trying to influence the market by setting out a bunch of different dot plots, et cetera. I'll leave you with two other things as we segue. I can't recall in my 32 years where you've had two forces within the government that are almost diametrically opposed to one another. One wants to potentially raise the front end of the yield curve, a la 1994. And for those that were around then, that was a 225 basis point rise over 6 action items to raise interest rates to stave off inflation. But now we also have the Treasury Department buying the long end of the curve, whether directly or indirectly, all while still issuing more and more debt to sort of fund the war, the conflict, whatever you so choose. So certainly interesting times that you not only have to study what's happening intraday, minute to minute, hour to hour, and not just wait for those reconciling items when you're selling loans and saying, well, how much did I make, or did my mark capture all the market moves, et cetera, et cetera. There's a lot that you need to take into account earlier in the pipeline and the origination process.
It certainly feels to someone like me that's sort of a casual observer to the Fed, unless they're trying to do something, that there's more uncertainty as to the path of rates. And I always just caution people, like, if you're scheduling to sell loans on Tuesdays and Thursdays, but there's a Fed announcement on Wednesday, you might want to change your schedule. Because if you're trying to sell servicing around a Fed announcement or a big speech like tomorrow, which may not be a big speech, you can expect a lot more volatility. And I just say it as simply as I can. It's uncertain where we're going with this Fed. He certainly seems like he doesn't like inflation, but I'm not sure I'm clear as to how he's going to measure inflation going forward. And I think that creates some uncertainty. Those 5 task force that he's got set up, it certainly appears like in an era of getting more and more data, we actually may get less and less from the Fed as far as direction. And that just, I mean, I'm in 2026, I'm sort of trying to reconcile this. This isn't like 1826. This is 2026, where we need more information, not less. And it almost seems like we're going to have a Fed that's going to give us less to work with. You could respond to that random comment.
Yeah, no, I would agree with that. I think capital markets folks, risk managers, always spend a lot of time thinking about the big move, right? What's going to happen to my pipeline if rates fall? What's going to happen for the next refi boom? And commensurate, they also think about what's going to happen 2023 coming out of COVID, 2022 when interest rates skyrocket. I think the tactics that folks need to ask from their capital markets and secondary folks are, we need to understand, and I'm going to paint a picture here for everybody, an equilateral triangle. And yes, I had to go look that up again because I couldn't remember what the equilateral triangle was. I think I got a C in, geometry because I'm an accountant major. So, but there are three areas in the risk paradigm that I want people to be really focused on going forward. Doesn't matter if rates go up, doesn't matter if rates go down. One is your lock desk policies, processes, and procedures, right? Those are going to be how you transact the business, varying by channel, maybe, extensions, roll cost, renegotiations. What do we do with higher pull through? What do we do with product switches? Make sure you're testing, retesting, and looking at those for relevance in the current sort of market. The second thing is how those are manifested in the manufacturing process. So your operations team that is ultimately originating and adjudicating and dispositioning the actual rate locks to loans, et cetera, and then selling them. Make sure that what the lock desk, whether automated or manual, is expecting to happen is actually happening in the LOS and in the data set. That third point feeds your risk management system. Whether you have a risk management system that's homegrown, whether you outsource it, or whether you're big enough to have an entire team of capital markets experts, we spend a lot of time looking at risk profiles, parallel shocks, things of that nature. And we lull ourselves sometimes into feeling, well, if rates go up, it's going to be this. If rates, go down, it's going to be this. Don't assume that each of those points of that triangle that I called out to you are going to interplay exactly the way that you think it's showing up on your risk profile.
This is a great segue into kind of the meat of this presentation. And at the end, we'll talk about where rates may go higher or lower from here. But sort of these hidden pipeline risk. And you and I have sat in boardrooms in 901 Sims Avenue and had our heads served to us for various things we did. But at the end of the day, a rising rate environment sort of introduces some risks and some real financial risks that aren't necessarily present when rates fall. And my quick example is if rates are falling and you have under-hedged and you've got more loans that pull through, those loans became more valuable. That is not the case when rates rise and you get more pull through. So you kind of painted a broad brush there, but go a little bit deeper on a couple of those topics, right? In this rising rate environment, we tend to get probably a little bit more pull through than we historically had. How does one sort of best manage that risk that is there that you, again, a parallel shock may not occur, or a few loans can really affect someone's gain on sale of the month? Talk through some of your expertise in that area.
Yeah, it's funny. The leakage, as I like to call it, the basis point leakage that you have by having these loans have a higher pull through, a flatter convexity profile, or a higher delta value for all those, quantitative ones, that can add up. And it can add up very, very quickly when you're already pricing thinner margins, when you're already trying to keep the gas in the tank and continue to rinse and repeat. I would say take a look at other options that are out there for different hedging instruments. And one of the things you have to understand is TBAs are fantastic, right? There's nothing wrong with TBAs, but you have to understand that TBAs are at first order derivative, they're a price focused measure. So shorting TBA is a price to price relative to what you're pricing the actual loan to.
And
There
I'm going to
are,
stop you there for a second,
yep,
Cameron. Price to price, meaning it absolutely is going to model this way, and it absolutely is going to move that way when I model it that way. So that price to price relies on both prices moving sort of in the same direction, not having a secretary treasurer all of a sudden going out and buying part of a curve or other speeches being said that could change the behavior. So when you say price to price, that means two things are going to move exactly the same for the exact change of rates. And we all know that often doesn't happen, correct?
correct, correct. So as you think about, well, what do I do, right? Well, there are lots of options, and no play on words here. I don't just mean go out and buy a bunch of options, right? That may be a strategy. That's a more sophisticated strategy. It does cost some money because you're buying an option, but Eris futures. There are treasury futures. There are opportunities to layer in, or what we like to call ladder in, a basket approach that as you think about those 3 points on that triangle, and as you look at what's happening with your pipeline, and as you run some tests, some taking a look at a set of rate locks and seeing, are they actually doing throughout the week what you think they should be doing? Because we are seeing enough movement in the market intraday and intra week, both up and down, that you can do these types of tests long before you're actually selling the loans and settling it out and working with your accountants and reconciling the cash. At that point, it's too late. If you've leaked 5 basis points and your gain on sale came in at 156 and you thought it was going to come in at 200, there's not much you can do there. But understanding what's happening to your pipeline in live time, while not messing with the data integrity, maybe in a test environment, things of that nature, getting a better understanding is what I think actually happening is what's actually happening, and is it manifesting itself in my risk profile. And
And
work with your
so,
hedge advisors or hedge partners, and ask them questions. What else could I be doing? What else could I be using? Speak with Seth and the team at Richie May as well about that.
so when we were doing our prep call, you made a comment. I didn't print a T-shirt for you, but you made the comment that if you're just slinging TBAs around your pipeline, you're probably not being as efficient as you can. And this is not a we're going to bash TBAs and oh my God, here's the new magic bean. But I sort of, and you and I have lived through this in past lives, right? I sort of refer to this as the witch's cauldron of hedges, right? Like, let's put some TBAs in, let's potentially put some treasuries in, let's put some Eris potentially in here. That combination or that um, recipe might serve you better in the long run than across a lot of the Richie May clients. We either find the following: they're either hedging using TBAs or they just go best efforts. And that is like day trading, saying, well, that stock's too high, so I'm not going to buy it. Stock's too low, I'm going to sell. Like, that's not, I personally don't think that's a great strategy. Assuming you have enough volume to hedge, you should hedge. So again, we're not saying that the TBA hedge is broken or you shouldn't use it. But I think the takeaway for many folks on the call is, there may be other instruments out there. And if your capital markets providers, your capital markets team isn't looking at them, it's time to look at that. Is that a fair statement?
Very fair. Think about first order. What are the type of products that you're originating? If the type of products that you're originating are all Fannie Freddie type products, Okay, then TBAs may very well be okay. If you're doing some non-QM products, if you're doing some prime jumbo, if you're doing varying degrees of those that trade at a spread or a reference or a different benchmark related to that, a cash flow benchmark related to that, then maybe it's time to think about how could I ladder in some additional hedges that might protect me differently in non-linear moves in rates.
And we've got a question from somebody about hedge models. So are the pipeline hedge models sophisticated enough to handle Eris futures, Treasury futures? I mean, you're much closer to that than I am.
So here's the good thing. In short, most are. Now, I don't want to be specific about any that are or aren't or whatever, but most are, because what has come a long way in hedge instruments is exchanges. So I am old enough, with no hair, as you can obviously see, that over-the-counter mortgage-backed security options were things that I used back in the day, and those are largely gone by the wayside because we use exchange-traded options. Erises are on the Eris exchange, CME, CBOE, CBOT, etc. So finding the price and finding a level one fair value market observable or potentially a level two is now much, much, much easier, and also makes, your accountants and your regulatory reporting folks and Fedicias and Sarbanes-Oxley and Basel reporting and call reporting and all that stuff much easier as well.
We're going to pivot, and that's a great, and again, that's great information, and it's just a cautionary tale, right? Like, as you said, if you've been doing that for a while, maybe think about this, maybe think about something else. We're not bashing TBAs. We're saying don't use TBAs. But these newer instruments out there are exchange traded. They may be less cash sensitive. They may be better from a counterparty risk perspective, et cetera. And you just may want to take a look at it. We're going to kind of wrap up here because we're trying to keep this to a tight 30 minutes. So this is the fun part of the presentation where we get to talk about, so rates higher or lower from here. And let's talk about higher, and then we'll end on the high note where rates are lower. Clearly, we've got 40 trillion of debt outstanding. We've got an ongoing conflict, at least in one part of the country. We may be invading Canada tomorrow. I don't know what's going on there. We got trade wars at a minimum. So again, 10-year Treasury is 468. It hit 474-ish last week. Kind of hadn't been above 470 in a long time. Cameron, how much higher can rates go from here? Or what can cause rates to go higher from here?
It seems to me that retesting, total personal opinion here, it seems to me that retesting that 5% area, particularly on the 10-year, which I think was last March of 23, if somebody wants to check the Bloomberg data, I think was the last time we were there. That seems to be the magic sort of area of move, right? Could we get back to 475 or 473? We could get back there in an hour or in 30 minutes. But the thing that worries me a little bit on this side is, make no mistake, we are trying to grow our way out of the deficit. That is the current administration's modus operandi. And so we still have to issue debt, but we are going to try to temper that debt from getting too high from a yield maintenance perspective, a la Treasury. Yet recent indications of PCE are basically saying they're stuck. They're not coming down as much as they are. And if anybody looks at the conflict in the Middle East, oil at 70, oil at 90, oil at 100, oil at 84. I mean, this is just what happens overnight. And so it's unlikely in sort of how I see things, it's unlikely that rates will spike to 5, but it seems like there's a drift to sort of retest that sort of area. And I think until there's more meaningful sort of accommodation made on all these other fronts that we're talking about, we're probably stuck in a higher for longer, my personal opinion.
And if people have looked at the latest MBA forecast, they've sort of moved long-term rates from 6.5 to 670 for the rest of my mortgage career, as I like to joke. And so that's about a 20 basis point jump. I did get booed off stage, and well, I was on stage in Texas. I didn't get booed off stage, but in February this year, I predicted that mortgage rates would hit 7 before they hit 5, and I got booed. But I feel pretty good about that bet at this point, particularly if you're talking about retesting a 10-year at 5%. I'm pretty sure that mortgage rate will hit 7 at some point, and I'm not rooting for higher rates. So let's talk about lower rates for a second. And I think from that standpoint, you look at a lot of the public filings of the major originators, and you notice the following. They're very heavy in refinance percentage. The MBA comes out and says, 80% of the volume in Q2, about 80% of the volume was purchase money, yet these companies are running maybe 50 to 60% of their originations are purchase. So that there's a lot of the publicly traded IMBs that are very heavy on refinances. And I'm not saying that we're not going to have a little bobble here and rates, there's a refinance window, they could be short, but the war ends. And all of a sudden, the strait opens and oil goes back to whatever it was, pre-levels, $60 a gallon. Clearly, the consumer is going to feel better. But does that really drive mortgage rates, given the debt and what you talked about earlier? I mean, I think there's a lot of folks sort of thinking about, well, if we could just end that war, rates will come down. What are your thoughts on that?
Yeah, I go back to the issuance of debt across the curve, right? And the issuance of debt across the curve has to be at a relative value and yield that's attractive to buyers. And so a dramatically falling rate environment with all of the right catalysts behind it, lower energy prices, slight slowing of the consumer spending, I just don't think are going to have the same sort of elasticity of dropping that interest rate like we've seen in the past. The events that we've seen in the past, take out the tail events and the COVIDs and things of that nature, have been fundamental dislocations in the market. A hedge fund blow up, a great financial crisis, a Russian ruble, these big events that happen that require massive intervention and sharp drops in yield. If we need to issue debt, we need buyers to buy our debt. The yield has to be relatively attractive on that. Yields are likely going to be at a higher, more accommodative level. The other thing I would mention, keep in mind, ARMs are still a very good type product. Yes, I know they're more bank driven. Yes, I know more of the banks are originating and buying those, but there is opportunity out there for the SOFR adjustables, 7.6, 10.6, 5.6, et cetera. So maybe take a look at those as well.
No, those are great points. And I'll summarize. There's only so much money out there that's going to buy fixed income debt, whether it's mortgage or United States debt. The more United States debt that's out there, it doesn't crowd out the mortgage market, but it doesn't really allow those mortgage rates to come down because there's a finite amount of money people are willing to spend on that side of the thing. Our key takeaways, and we always like to wrap you up with a couple key takeaways, and Cameron hit all these earlier, but ensure your capital markets policies and procedures are up to date to prevent that gain on sale leakage, differentiate between channels and products, ensure your controls and oversight are in place on the operation side, and just understand there's a lot of volatility in the market. There's a lot of uncertainty. your capital markets areas haven't gotten dumber. They're dealing with a different situation, a much more volatile market. We've got macro global economic issues, and we have an election. So just remember, there may be a lot of volatility and a lot of chop here going forward as we kind of wrap out the year. Cameron, I can't thank you enough for joining us. I knew we would spend 30 minutes and it would feel like 3 minutes talking this topic. Thank you again for your time. We will follow up with the questions that we didn't answer. Please fill out the survey. But again, Cameron, thank you very much for your time today. Thanks everyone for joining us. And we'll be back with another trend series, I believe, in December. So thanks again, everyone. Thanks, Cameron, for your time today.
Thank you, Seth. Thanks, everybody.